Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. It's Friday. We made it to the end of the week, and what a week it was. It was a down week in the markets, and we're down again today. Down about 300 on the Dow, down about 200 on the NASDAQ. We broke that support at 390 on the SPY. We broke support, and we're probably going to come down to the June lows, but we probably will not go straight down to the June lows. So I do expect we're going to get a bounce somewhere along the way. We're a little bit oversold right now. Not a lot though, not a lot. We could continue this downward path down to the June lows. You see now we're at about 385 on the SPY, and I think we'll come down to about 360 where the June low was made. Now we had these gaps this week. Now a gap is when you close at one level and then you open at another level. There's a gap, and the gaps this week were down, right? We had that big gap down on Tuesday, and now we have another big gap down today. Now a lot of times the market goes back and refills those gaps before heading in the direction of the gaps. So we might come back up to what we're about the 50-day moving averages on the SPY, filling those two gaps, and then coming back down and retesting that June low. That June low is not safe right now. There's a lot of downside risk in this marketplace. All right, today I want to talk about, the house of cards that we're living in. And this is just not all about real estate. It's about the United States. And, I want to talk a little bit about the wealth effect. The wealth effect. Do you realize that just the U.S. stock market since the beginning of the year has wiped out 7.6 trillion, with a T, trillion dollars of wealth, of household wealth in America? Isn't that a lot? That seems like a lot to me. Now, what you got is, let's just say you had $1 million in your retirement account. Let's say you're an older person approaching retirement, and you had $1 million in that account. Now, look it. If you're down 20%, all right, so the $1 million is now down to 800,000. But it's a little worse than that because, with rough numbers, we got about 10% inflation. So what you started the year out with at $1 million is down to 800,000, but it can only buy 700,000. All right, that doesn't sound too terrible. You got 700,000 left for retirement. What if we do this again for another year? All right, so you drop another 200,000, and maybe the inflation picks up a little bit. You drop another 100,000 there, and all of a sudden you went from $1 million down to 400,000. Now this is a wealth effect, right? You were feeling pretty wealthy when you had that $1 million in play, but now you only have 400,000 in play, and you're looking at retirement. You're staring it straight in the eye, and you don't have the money left. What do? You start to, maybe increase your investments. Maybe you start to take riskier investments to try to get it pushed back up. Maybe you go into some cryptocurrencies or something, trying to get back to that $1 million level so you can retire. The wealth effect is kind of like a domino effect, right? It's great when it's going up, but when it's going down, it's just like dominoes. It's just dominoes. They're all knocking everything over. Now, what's the biggest domino right now? We got that inflation thing going on. Now the government, they'll tell you we're running now somewhere between 8 and 9%. I really think it's somewhere between 14 and 15%. If you measured the way they measured in the 1980s, we'd be up about 14% right now, right? All right, so you got this inflation thing. Now, what did we do in the 1980s to get rid of inflation? They had inflation running about 15%, and they had to raise interest rates above the rate of inflation. See, a lot of people don't understand that. If you want to fight inflation, you got to come up with a real rate of interest. Now, let's say right now the Fed's going to raise rates to 3%. They're going to raise them up to 3% next week. Okay, so we'll be at 3%. But we got inflation running at 8 or 9%. Let's just call it 8%. So you got inflation at 8%, which means you have a negative 5%. Meaning if you just have your money in bonds, like you bought a bond from the government, and you're getting 3% on your money, you're losing 5% every year. So if you had 100,000, you bought this bond, 3%. By the end of the year, you bought a 1-year bond for 3%. At that end of that year, you actually have $95,000 worth left in your purchasing power. Now, nobody really wants to do that. Nobody wants to do that, right? So my point is they have to get a real rate of inflation. But here's the thing. You see, Federal Chairman Powell, anyways, he says that he wants to fight inflation. He's going to get this number down to 2% no matter what it takes. Well, he's just blowing hot air because there's nothing he can do. Now, I want to explain this to you. Now, this is just some straight talk on a Friday. It's just common sense. There's no economics, no wild magic stuff involved in this. Okay, so let's think about it. Okay, for a long time, the government's been running this deficit, right? And we built up $30 trillion in debt, $30 trillion in debt. And that was all fine when, we were getting 0% interest rates. It's 0% on $30 trillion. Well, we could afford that as a country. We could afford that payment because it's pretty much nothing, right? But for every 1% that you raise the rates that they're selling the bonds at, every 1% it goes up, that's an extra $300 billion a year that we as taxpayers, we have to pay. Now, Powell says he's going to raise this rate up to 4%. 4%, so $300 billion times 4 is $1.2 trillion just in interest rate payments on our $30 trillion of debt we have. Okay, so we're paying $1.2 trillion. But now if he wants to fight inflation, he's got to raise it up at least to the level of the inflation, right? So let's say he raises rates up to 8%. Well, how much interest would we have to pay on that $30 trillion? Well, we'd have to pay $2.4 trillion just in interest rates. Now we bring in tax returns, let's call a rough number. Let's say we bring in about $3 trillion a year in tax returns. I think it's 3.2 or something like that. But okay, so we bring in $3 trillion and we're putting out $2.4 trillion just in interest rates, okay? Just in interest to pay our debt. Well, what does that leave us left to run the government? What does that leave us left for all these stimulus programs? Not a lot, not a lot. It really doesn't leave you a lot. But let's say we have to get to the real rate of inflation. That's just real rate of inflation being about 14 or 15%. So let's just say they raise it up to 12%. 12%. All right, 12%. What would that do? Well, let's think about that. That would be $3.6 trillion that we would have to pay on the national debt. $3.6 trillion every year. We do not bring that much in tax revenues. All right, so this is the problem, right? So what is the alternative? Well, the U.S. can default, which is a possibility, but I don't think it'll play out that way. Are they going to print the money? And when they print the money, what's going to happen? Well, they're going to hyperinflate. They're going to hyperinflate. But Mike, they did this in 1980 and nothing happened. They raised interest rates up to 20% in 1980. Well, that was Paul Volcker, right? Now, okay, in 1980, they didn't have no $30 trillion in debt. They did not even have $1 trillion in debt. They had about $800 billion in debt, so they could raise rates up to 20%. And the country could afford it. Right now, we cannot even afford to raise them up to 4%. So all Jerome Powell really has to do is try to talk this inflation down. But I'm telling you, it's not going to work. It's not going to work. There's no way he's going to get this inflation down. We're going to inflate farther, right? And at some point, when you get to that 4% level, now here's where it gets interesting. We get the house of cards that's going to come crumbling down. Now, the house of cards is going to start in the real estate market. Now, it's already started in the real estate market, right? It's already started. Okay, we're down about 10% in many cities. But when you get to a 4% rate, you get everybody wanting to get out of the real estate market. Now, at 0%, we got all these corporate buyers coming in to buy the houses and to bid them up. But at 4%, we got all these corporate Well, they were buyers. Now they're going to be corporate sellers, and it's going to bring down the housing market. We're going from a shortage of houses to an abundance of houses to an oversupply of houses. Now we already have an oversupply of houses in the new housing market. We got about 12 months of inventory already. But the corporations, they got all these houses that they're going to be selling if rates get up to 4%. And it's going to send the house of cards. It's going to come crashing down. It's going to be like this domino effect. That's the first domino. Okay, what's the next domino? It's going to be the stock market. That's going to come tumbling down. But at some point, the Fed, they're going to have to pivot. They're going to have to pivot because they can't handle the pain. They can't handle the pain of the markets come crashing down. So they make this pivot. They go, oh no, 4% was too high. We got to lower the rate. Let's get it down to 3%. Let's get it down to 2%. Let's get it down to zero again. Zero again will be okay. Well, let's bring it negative. Let's have negative rates in the United States. It's going to be shocking when this happens, but it's going to happen. It's going to cause this hyperinflation, and inflation is going to run away. It's not going to be at 10%. It's not going to be at 15%. It's not going to be at 20%. It's going to take off. Now you say, Mike, you're just doom and gloom. Well, that is true. We could have another alternative where if they did actually want to keep the rates high, 4%, 6%, 8%, then we get the other alternative, which is the Great Depression. Now, you can't say the word depression. We'll just go with severe recession. We're going to have a severe recession in the United States. Now, you can't even say we're in a recession right now. We've wiped out $7.6 trillion in the stock market. We've had this negative GDP printing for 2 quarters, and I bet it prints again negative for the 3rd quarter. But you're not allowed to say recession. It just kind of frustrates me that they can't be frank with the American people. Look, we're in trouble. We're in a lot of trouble. You can tell that. I know that. You watch my channel, and a lot of you think I'm this gloomy guy. You know, that $30 trillion in debt that we have, that doesn't take into account these unfunded liabilities, which is another $100 trillion. Look at us baby boomers. We messed it up for you millennials. I mean, they'll tell you that, you know, us baby boomers are the smart ones, but we're not the smart ones. We messed it up. I mean, we voted these politicians in, and well, they messed it up with all this printing of money. Look at just in the last 2 years, we printed $6 trillion. You cannot do that. You cannot do that and have no effect. The effect right now, we're seeing that. We're seeing that with this inflation taking off. We're seeing that with the housing market coming down. Look at the housing market is very interest rate sensitive. And when you get up to 4%, you're going to have mortgages. They're going to be running up about double that, about 8%. And that people just can't afford to buy. The housing market has really come to a grind. I mean, there's just nothing happening. Now, normally we're in a slow time of year. After Labor Day, it is the slower time of year, but we've just really come to a standstill. I mean, things are not selling. Things are not moving through. Mortgages, I mean, you know, the refinancing is non-existent. This housing market is what's going to be the canary in the coal mine. It is going to come down 20, 30, 40, 50%. Now, people say, Mike, that can't happen. I know it can't happen in your area, but in most areas, that's what's going to happen. And we do have this problem. We have this problem of inflation. We can't fight inflation because we can't afford to fight inflation because we're so much in debt. Now, I know this was a terrible rant on a Friday because it is the weekend and everybody's going to go out there and they're going to enjoy the weekend. It's going to be a great weekend. Anyways, if you like this stuff, give me the thumbs up. If you really like it, punch that subscribe button. Didn't mean to get so negative right before the weekend, but get out there and have a great weekend. And I want to talk to you again next week. I'll try to be more positive, more optimistic. Maybe a white swan will fly in this weekend and everything will get fixed. We'll see what happens. I'm Tall Mike. Bye-bye now.